Right guys, so obviously as you can see, I am not Mark. I'm actually at Mark's at the minute to film some bits for Falcon. So we've got a lot of new things coming out this quarter as well. So we've already revamped a lot of the education structure on the back end of last year. But these things that we've got coming out, I just added layers, niche different topics that maybe we've discussed on webinars that we haven't actually got officialized content for. So I'm excited for that. But this week's YouTube video, what I wanted to talk about, I wanted to use a student as basically a case study. Right now, I'm not going to mention his name, but it's very, very relatable to a lot of you. Now, this person individually has actually lost 2 accounts within the space of 1 year, and he's been trading for a total of 3 years. But the first year and a half, he wasn't actually putting in too much effort, and even if he wasn't putting into towards the right thing. So what you'll find as well is we don't actually have people failing 20, 30 accounts and then reaching for that one payout. That mentality isn't great. You won't get that here. Normally, what you find is if somebody fails 1 account or 2 accounts, they'll normally reach out to myself, Abdu, or Mark, or even on a webinar, and actually ask for tips or pointers. If not, they'll book a call with either me or Abdu. Now, what I want to demonstrate is tips that you can actually use. Now, see a lot of YouTube videos that you see regarding trading tips, they start out the same. Top 5 tips, top 10 tips, and they don't actually have much substance that you can actually apply, no practicality towards them. Anything I try to say, anything that's put forward on this channel, we aim to have practicality towards it. There's no point me giving you tips if you can't practically use them and apply them and see improvement in your trading. So the first thing I want to bring your attention to, which is something that you might be aware of as we have spoken about it before, but in this context it'll make more sense. So this is called a trading trifecta. And you can see it's got 3 different elements to it that you can see there. And this triangle is not complete without any of these elements actually existing. So what I mean is, imagine if you've got a stool with 3 legs. If one of those legs are missing, that stool is not going to be able to hold its weight properly. So every single leg has to be present. And in trading, what those legs represents, very, very simple. Number 1, you need a trading system. Obviously, this is a method that you use to trade the market. It's kind of like learning a language. There's no point in me trying to learn Chinese for 2 weeks, going to China and thinking I can just hold a full-on conversation with somebody. When you have this system there and present, it's like a language. You have to spend time learning it, letter by letter, word by word, and eventually you can put forward sentences and maybe even read a book at some point, who knows. But regardless, your goal is to learn that system and stick to one system and master it. That's portion 1 though. Section 2 of that is you need to actually have a criteria that you're following. This is what you'll know as a trading plan. So when you've got a trading plan there, you need to make sure that you have effective setups within that trading plan. You see a lot of people within their trading plans, they'll have all these different setups, but they've not actually tested the efficacy of those setups. They might have gone back and back tested them, but they've not actually seen in live data how do these work. You know, when I first formulated my own trading plan, I had a very, very brief 2 or 3 setups in there, very simple criteria, really black and white. And I knew logically that even if I apply this, it doesn't mean that I'm going to have the best results. I will likely have a lot more losses because I've not refined these setups yet. So I will then trade them in the market for about 4 to 5 to 6 months. Because I've got a base to refer back to every week, and I can see, right, these past 4 weeks, I have followed my plan X amount of times. I might have followed it 60% of the time. If I had followed it 100% of the time, what would my results have looked like? And because I'm focusing on very, very minimal amount of setups there, I can spot small details that I wouldn't have spotted otherwise, because my horizon would have been so broad before, I don't know exactly what to focus on. Whereas now, because it's a narrowed horizon, I can focus on very, very specific key details and improve my setups therefore. Now, that's number 2 there that you need to focus on. Number 3 is your mind. Now, remember, I've not put this in a particular order. All these things eventually have to work together in synchronicity. If you're missing one of these things, it's not going to work. So for example, you can have an amazing system that has a fantastic proven edge. You might even have a fantastic trading plan. But if you've not worked on your mind, you can't even apply those things. There's no point. It's like having a really shiny Ferrari with no fuel in it and nobody to drive the car. It's pointless. It's just sat there, parked there, looking good and doing nothing. So a lot of you have a fantastic system. You may even have a fantastic method to trade, but you've not worked on your mind to trade that method. Or you might find that you've not even got an effective trading plan. It could be different.
So before we move further into this episode, I want to touch on something very important that's going to be a key catalyst by you being consistently profitable long term, and it's psychology, but it's about having the right training. If you haven't been aware, for the last couple of years, we've had hundreds of traders go through our program, Rewired. As you can see here, we have Beyond Rewired and our core modules. Now, the core modules is essentially the A to Z to helping you learn how to think calmly under pressure. The end goal is to get you in a position where you're not nervous, you're not reckless, you're not revenge trading, and a whole bunch of other destructive things that are holding you back from getting to the next level. Now, these modules have been intentionally designed to essentially reshape the fabric of your mind and will be the key reason as to why you're not being profitable long term. You might have been someone who's had success here and there. This is going to help the consistency come in at such a high level. We can attribute over 90% of our traders that are on our in-house fund have gone through Rewired. So if you want to learn more about the Rewired program, all the links are in the description.
You might even find that your system is not even dynamic enough. You might even have a broken system. Just because you see other people trading it doesn't mean it's an effective system. And you need to make sure it's a method that is applicable in any condition in the market, irrelevant of what's going on in the world, whatever situation is going on economically. You want to be able to make sure you can trade any single pair as well. If you're limited to one pair or two pairs, then you're going to screw yourself at some point. But regardless, getting into the case study itself. So with this student, like I said, he's been trading a total of 3 years. For the first 1.5 years, he wasn't really focusing on the right things. And then eventually, after failing 2 accounts, he reached out and we worked together. Now, in his situation, what's very interesting is he didn't actually know what his issues were. He thought they were psychological, but usually when people think they're psychological, they're not. And vice versa, when people think they're technical, they're normally psychological. I've noticed that pattern with coaching people. So when we jumped on, all I assessed was his 10 most recent trades. I looked at them and I thought, okay, first let's have a look at these trades and see, have they met the plan? And his plan, by the way, is an effective plan that if he follows it properly, he will make money. That's how simple his trading plan is. So have they first of all met that plan? And secondly, what is the risk grading on these setups? So for example, he might have taken all those 10 trades and they've all met his plan, but if they're all high risk, what do you think that does to his performance? What do you think that does to his chances of actually making money in the end? So I went through those positions with him and I found that 75% of those positions were high risk. All of the trades met his plan, so he has a very good ability to actually follow his plan, but 75% of those trades were high risk. So what do you do in that situation? I have to ask him, right, why did you take these high risk trades and when? So we have a very simple ruling system that I'm going to show you now. Think of a numbers line here. So you've got break even, -5 and +5, just as an example that you can see there. Right, and what happens is, whenever they're going to dip beneath break even, which happens to any trader, it doesn't matter how long you've been trading, 15 years, 20 years, 30 years, 5 months, you will dip beneath break even at some point. So whenever they're going to dip beneath break even, if that does happen, we want to make sure they're only taking low risk positions. Now the reason why, and this is a very simple way to approach your trading and risk management as a whole, is because if you're in drawdown, why are you going to put yourself in a position of taking higher risk positions? What's the point? You know, you're in drawdown, your goal there is to get back to break even. Your goal isn't to make money and go into profit and get that payout. That's a silly mentality. Your goal is to get back to break even and incrementally get out of drawdown. So the best thing that you can do is you can control the trades that you take. You can't control the outcome, but you can control the type of trades that you take. When you're in positive, that's when you have room to actually take high risk positions. Normally what we say is you want to give yourself a 4 trade buffer. So say if you're risking 0.5%, which most of you should be, fixed. If you're up 2% in total profit, you've got then 4 losing trades back to break even. So at this point now, if you're 2% or higher, you can actually afford to take high risk positions. So I was approaching this model with this student, and what I found was as soon as he went into drawdown, all of his trades then were high risk. If he'd just not taken any trades that were higher risk by being in drawdown, or even by being at break even, then you would have found that he would have finished on break even instead of obviously failing his account. That's how simple it can be. So then I have to dive into, right, the trades that you took were high risk. You took them at the wrong time when you were in drawdown. Knowing that you shouldn't have taken them in drawdown, why did you actually take those positions? That's then when we can isolate that it's a psychological problem. And we actually dove into it, and he was very out of routine for the past 3 to 4 months of trading his account. And because he was out of routine, his decision making was affected. You know, if you're back and forward on sleep, for example, in Ramadan in March, I missed so many positions that I would normally take, but my sleep was up and down constantly. So there's nothing I can control about that. You know, I've got to look at my priorities and see what I can focus on. But does that happen every month? No, it doesn't. It's 1 month in the year. But for this student, it was actually a commonly repeated thing in his trading that we had to fix. So what was the root of it? It was routine based, it was sleep based, it was the fact that he was waking up in a horrible mood. And those things affect the way that you decide. Secondly, you also have a threshold. Something else that I want to show you here. Everybody has a threshold, every single human being. And when you cross that threshold, I'm going to circle it there. Whenever you cross that threshold, that is when rational thinking goes out the window. You can know your system like the back of your hand. You can be very, very good at executing your strategy, maybe even in simulated trading. But when it comes to live trading, you might have an issue where, let's say, for example, you lose 3 trades or 4 trades, whatever the number is for you. You might even miss 4 or 5 positions. Everybody has wired themselves in a way where they're attached to a certain number. When that number's crossed and that threshold's crossed, your rational thinking will go straight out the window. And that's a proven scientific fact that you cannot argue with. My question to you is, have you even figured out what this threshold is for you? If you don't know that, at one point it's going to come back and bite you. And for him, as soon as he lost 3 positions and he went back into drawdown, so I think he was up around 3% or 3.2%, he lost 3 back-to-back trades, went straight back to break even, slight drawdown, and then that's when he started to take the high risk positions, when he knew he shouldn't have. In fact, in his comments, what's interesting, when I looked at his trade afterwards, in all of his trades that he took, he knew he shouldn't have taken the high risk positions, but he still did. So that's what you've got to dive into and actually figure out, why is it traders do behave that way in the end, if not yourself. Second thing that I noticed when I looked at his technicals, so there was one technical problem that was very, very important to focus on, was time frame usage. A lot of these trades that he took, the reason they were higher risk, he took them on the lower time frame. So the lowest time frame that we go to is the 5 minute. And these trades were underdeveloped, they were premature, you should not have taken them, hence why they were higher in risk. Had he have just waited, the trade either would have been invalidated, so you wouldn't have taken it, or there would have been no trade there. So a lot of these trades are either forced, created, or got into very, very early. Now, time frame usage is a very, very important thing. I demonstrated to him that you don't always need to go down to the 5. Sometimes you can stick to the 15, hourly, or even 4 hour for an entry, which I'm going to show you now on the charts. So if you can see here on pound dollar, I've got a very brief example. There's one quick 4 hour entry here that you can see. Now, the entry model that I'm using here is a limit order entry model. I'm not gonna obviously go into too much detail here as of now, but the limit order entry model is used when you can't necessarily get the entry that you want, providing the risk to reward that you want, but you still wanna get into the trade because it's still a great trade. It's just that you can't time the entry effectively. So in this case, if we're gonna use the 4 hour, because it's a much larger structure, which you can actually use, I don't commonly trade the 4 hour. I'm still live testing it, yet to implement it into my trading, but I'm going to show you a very clear example of a trade that you can see here on the 4 hour time frame, where it's more than reasonable to use because we've got a larger structure. And you can set a limit order here, your stop loss is at 35 pips, you're nice and protected. And what you can see is I would have got out of this trade for about 5.6, 5.8. Very simple trade. Again, proof that you don't need a lower time frame. I can show you so many trades. I'm not just trying to cherry pick here and show you one trade. I can show you loads of different trades. The next trade that you've got here is on pound dollar. So this one was around the 14th of March that you can see there. 20 pip stop, 1 hour time frame. So no 15 minute, no 5 minute, you don't need to go to that yet. This trade would have been 3.1. And there's one final trade on Aussie dollar as well, right? Again, this video is, by the way, not a full-on trade market breakdown. I'm just trying to demonstrate something to you about time frame usage here. So on Aussie dollar, this trade was also on the 18th of March. 1 hour time frame, simple execution. Like if you were to look at all the trades that we take, they're very, very consistent. There's no big chopping and changing. There's no drastic change between trade A and trade B. All the trades are consistent. There's a very simple mechanical thought process behind each trade. And I'm not sat here stressing about analyzing my charts. Like it doesn't take me long. For example, on the weekend, I'll spend about an hour or two building my entire watch list for the week ahead, not trying to analyze one pair. We're not limited to one pair. I can trade indices, commodities, you can trade normal FX pairs, you can trade stocks, futures, anything. This system is so dynamic, you can literally apply it to anything. So if there's any kind of turmoil in the economy, anything's shifting or changing, I don't have to worry as a trader because I know I'm diversified across any single pair and I can trade that. And that's a very good position to be in. You shouldn't be in a position where you're stressing out, thinking, right, euro, dollar, or whatever pair you specialize in is not providing you trades right now, and you're panicking. You will naturally be hit with cycles where it's less opportunistic markets, okay? And when that's the case, you need to take a step back. And normally people, they don't do that and they force trades and they ruin the results and then they blame the month and say, oh, February or January or March, whatever month it is, a poor month to trade, or euro dollar's been horrible this month or whatever it is. No, the market's just doing its thing. You can't blame the pair. The conditions are the conditions. But if you're stuck to one pair, you're gonna have to understand there's gonna be certain months, certain periods where the market's just not gelling with your system. Anyway, so this trade here is a 1 hour time frame, okay? Now, why am I showing you these trades and demonstrating them without obviously breaking them down in detail? This is what I explain to the student as well. Just because you can see a trade on a super low time frame like the 5 minute doesn't mean it's a trade worth taking. It's not the fault of the time frame. It's actually the fault of the person executing on that time frame. You have to understand when you're going down to such a low time frame, you need to be able to build it in a certain way. We've covered that in the mechanics section for our students as well, so they can actually see that. And the way in which you build it has to be very, very mechanical because you can apply that to every single scenario that you approach in the market. So to conclude, for this student, what we found in the end was, I mean, even if he just didn't take the higher risk positions, he would have been at break even and he wouldn't be in a position where he lost his account. So again, he's in another position there where he can still grow his account. If we now even take into account positions that he missed on top of that he should have taken, but he wasn't involved in because he got involved in the poorer quality positions as a side effect of what I just discussed, he would have not just passed his account, but he would have actually scaled up another level. So that's in the space of 3 months. Think about that for a second. 3 months of trading could have been the difference between failing an account and not only passing, but scaling up another level. So 3 months that can be achieved. Now, this is somebody who's got the ability to get coaching. This is somebody who's got the ability to be mentored because he's in our ecosystem. But those of you out there and you're on your own, you've not got a mentor that you can reach out to, you've not got a coach that you can reach out to. I've saved this guy about 1 year and 2 months. I'm estimating that, roughly. A lot of you are trying to tackle it on your own, and I get it. Look, I was self-taught before I came into Falcon. I first started trading around December 2016, and for about 17 or 18 months after that, I was completely self-taught.
Well, originally before that I was self-taught, so the main aspect about that, it was quite lonely. So with this, the biggest value you get is you get that community there alongside you, which keeps you going, because when you got no one with you, you don't know whether you should keep going or not. And when you've got people going through the same experiences, it helps out a lot. That's probably the biggest take I've got from Falcon.
Now, I know you've got access to more resources, I know you've got access to more information, but there's a problem with that because people are drowning in information but starving of wisdom. It's a quote I like to refer back to all the time. You've got all this information to have access to, but how do you know how to decipher between what's right and what's wrong if you've got nobody ahead of you trying to guide you? And even if you have, you need to make sure that you have somebody that you can reach out to and that they can assess your trading and they can look at you, because at some point you're going to need that. Look at all the professional traders that have traded behind desks on institutions. They would have performance reviews every single week. They'll have somebody over the shoulder looking at them and guiding them and mentoring. You can't just do this on your own and expect not to have more of a difficult time. Trading's difficult anyway, but you don't want to make it more difficult than it needs to be. And that's the problem that people don't actually see, is they make it way more difficult than it has to be. All you've got to do is put all that money aside that you would have spent on the next 15 or 20 accounts that you're likely going to blow anyway. Put that money aside, put it into education, and save yourself all that time, all that energy. Time is something you never get back. People become very complacent with that. They think, oh, I've got all the time in the world. You haven't. Time is always running out every single day. And I'm not just saying this to try to bring urgency to you for no reason. It's true. You're only going to be this young once. You're only going to get this chance once. So make the most of it and don't just spend it on the next 15, 20 challenges trying to blow it and thinking, oh, one day I'll get a payout. You'll get that payout, but how are you going to assure that you're going to have the same level of confidence after it? You might blow 18 to 20 accounts. You've spent all that money. Now guess what's going to happen after that? If you spend all that money and you now get a payout that covers for all these expenses, you think you're going to have the same level of confidence that you did when you started? So there's all these things that you got to work on. Understand the trading trifecta. It's very, very important. Look at those different sectors in your trading. And I hope you took something away from this video regardless. It's a very quick case study to actually demonstrate the importance of time frame usage, how sometimes technical issues can be fixed over one call when you're speaking with somebody who knows what they're talking about, and how a lot of things can also be psychologically derived. Not everything, but certain things can. And that's how something so small as a routine can affect the way that you make decisions, and could sometimes be the decision between you completely losing an account and then scaling up to the next level.